Welcome to CoreLogic's final housing market update for 2020, brought to you by onthehouse.com.au. Australia's housing market continued along a recovery trend through November, with our National Home Value Index recording a second consecutive monthly rise. With dwelling values up 0.8% over the month, the new recovery trend follows a 2.1% drop in Australian home values between April and September. At this rate of appreciation, we're likely to see CoreLogic's National Home Value Index surpass pre-COVID levels in early 2021. Although housing values look set to surpass their pre-COVID highs early next year, both Sydney and Melbourne home values remain at levels similar to those seen in early 2017, while rising Perth values are similar to levels in 2006, and Darwin values are in line with 2007 levels. At the other end of the spectrum, housing values moved to new record highs in Brisbane, in Adelaide, Hobart and Canberra through November. House and unit values have diverged over recent months. House values have driven gains in the combined capitals index over the past 3 months, rising 1.1%, while the rate of decline has eased. Capital city unit values fell by 0.6% over the same period. This trend towards stronger conditions in detached housing markets is evident across most of the capital cities. Relative weakness in the unit market can be attributed to factors including low levels of investment activity, high supply levels in some regions, and weaker rental market conditions across key inner city unit precincts. Melbourne's unit market is the exception, where unit values have recorded a smaller than expected decline through the COVID period to date and a more substantial recovery trend over the recent months. This resilience in Melbourne unit values is surprising, given the high supply levels across inner city areas and the sharp decline in rental conditions. We suspect the stronger trend in Melbourne unit values relative to houses could be short-lived unless overseas migration turns around sooner than expected, which would help to shore up rental tenancy demand. The stronger performance across the regional areas of Australia continued in November, with CoreLogic's combined regionals index recording a monthly growth rate double that of the combined capitals. Regional home values are up by 1.4% in November, compared with a 0.7% rise in capital city values. Regional Queensland has led the rise in values over the past 3 months, posting a 3.2% lift, followed by regional New South Wales, where values are 3.1% higher. Regional housing demand is being supported by a range of factors, including the normalisation of more flexible working arrangements across some occupations, as well as lifestyle factors, lower housing prices, and improved transport options. With many employers now embarking on a return to office program and the price gap between the capitals and the regional markets narrowing, this trend could gradually start to lose momentum, but we're expecting the regional lifestyle markets to remain in high demand for some time yet. The lift in housing values comes as a range of other indicators point to a further improvement. Inventory levels remain low across Australia at a time when demand is rising, leading to a market that's favouring sellers over buyers. The number of properties advertised for sale remains 20% lower than this time last year and 24% below the 5-year average. Total listing numbers are low despite a sharp rise in fresh stock being added to the market. The spring period saw a 42% rise in the number of new listings added to the marketplace nationally, while the total number of listings dipped by 0.6%. This reflects a strong rate of absorption as prospective buyers continue to outnumber newly advertised supply additions. The number of settled sales has held reasonably firm since July, with rising sales activity outside of Victoria offsetting the sharp drop in Victorian home sales caused by the recent lockdown period. Nationally, CoreLogic's settled sales estimates over the past 3 months were about 1% higher than the same period last year. This is partially due to the stronger demand across regional areas where buyer activity has seen a more significant lift than their capital city counterparts. Auction markets have strengthened as well, with November clearance rates holding around the 70% mark. That's well above the decade average of 61%. The strength in auction clearance rates comes as the number of auctions rises into the first half of December. Higher auction volumes will provide a timely test of the market depth prior to the seasonal slowdown through late December and January. Private treaty measures are also tightening. The median selling time has reduced from 57 days in June to 42 days in November, and discounting rates have reduced from 3.9% in April to 2.8% in November. Sydney housing values recorded a second consecutive month of value rises in November. However, housing values remain 1.9% below their pre-COVID levels and are still 4.6% below their earlier mid-2017 peak. As the market moves into recovery mode, house values are rising at a faster pace than unit values, up 1.2% over the most recent 3-month period, while unit values are down 1.8% over the same period. Across the sub-regions, the Central Coast and Northern Beaches are recording the strongest appreciation, with home values up 3.2% and 2.4% respectively over the past 3 months, while the weakest conditions are in Ryde, where values are 2.5% lower over the past 3 months, and the City and Inner South region, which has recorded a 1.6% fall in values over the same period. In summary, housing demand is rising due to the broad range of stimulus measures and changes in market sentiment. Record low interest rates are only one of the factors supporting a lift in buyer numbers. As demonstrated by the September quarter GDP figures, a stronger than expected improvement in economic conditions has flowed through to a surge in consumption, tighter labour markets, and lifted consumer spirits to higher than pre-COVID levels. State government incentives, including changes to stamp duty and additional building grants, are also supporting demand. As buyer numbers rise, available inventory has remained low. This creates some urgency amongst buyers and in turn adds to the upwards pressure on home values. Buyer demand is mostly being fueled by a surge in owner-occupiers rather than investors, especially first home buyers, which now represent more than 1/3 of owner-occupier demand. The housing risks associated with less fiscal support and the expiry of mortgage repayment deferrals have lessened over recent months. Job numbers continue to improve through October despite the windback of JobKeeper, and the large majority of mortgage repayment deferrals have already moved back into a repayment schedule. At the end of October, less than 4% of mortgages remained on a deferral arrangement, down from 11% in June. Although the recovery trend is being led by owner-occupiers, with prospects for capital gains becoming firmer and more rental dwellings showing the potential for positive cash flow, it's likely investor numbers will become more substantial in 2021. Historically, we've seen investor demand mostly concentrated within the largest capital cities. However, with lower price points, higher yields, and arguably better prospects for capital gains, the smaller capitals and regional centres may attract more investment attention in 2021. Focusing on one of the riskier sectors of the market, inner-city apartment precincts of Melbourne and Sydney remain exposed to weak rental demand and high supply. Although the pipeline of high-rise apartment projects has reduced sharply, it will be some time before the large number of projects under construction work their way through to completion. With rents and occupancy rates falling, the outlook for this sector remains weak. As 2020 comes to an end, I'd like to take this opportunity to wish you all the best for the festive season and good fortune for the new year. Let's hope 2021 is a little less interesting than 2020.